talk about the 5 shapes of the yield curve. What does that say about the future of the economy? So here is a quick overview of the 5 different shapes. So later I will discuss each shape in detail. So with just a quick overview, they have a 5 different shape. Is normal. You can see this one is the normal one. So it's upward sloping. Then you have inverted. Inverted is the red one, so it's downward sloping. Then steep. You can see steep basically have a bigger slope, higher slope than the normal. Then the flat is basically is a flat line. The humped is you increase yield, then later you decrease. So this is basically is a 5 shape. We're gonna discuss it in detail each one. So before you understand the shape of the yield curve, just something you should understand. Then it will help you better understand the shape. So first of all, what is the yield curve? The yield curve shows the relationship between the today's bonds yield. So those are the today's yield is spot rates, and the relationship between those spot rates and the time of the maturity. Then we only talk about the government debts. Government debts is treasury bills, loans, and bonds. So this is a different time of the maturity. Because the government debt, they have their own characteristic because they are seen as a risk-free assets, so or risk-free investment. So because they are different from the corporate debt, corporate bonds. So that's why you have to understand it. That's why sometimes the yield curve shape differently because of this reason. Then you also understand the Fed controls the short-term interest rate and then the short-term yields. Then the expectation of the interest, inflation, and the economy influence the long-term bonds yield. So basically, the bonds investor, if they have an expectation of the interest rate go up and down, inflation go up and down, or the economy is gonna go slow down or go in recession, those will influence the shape of the yield curve as well. So in normal economy, you always think risk reward holds. So basically, said the you buy short-term bonds should expecting lower yield than the long-term bonds. So that's a risk reward. The duration matters. The longer the duration, the higher the risk. So then you have to understand the relationship of those things. Say if the interest rate or the inflation increase, so then the demand, especially for the long-term bonds demand, the demand for the long-term bonds will decrease, right? If the interest rate increase, nobody wants the current bonds at the lower rate, so demand of the bonds decrease. The decreased demand will cause the bonds price to go down. The price go down will cause the long-term bonds yield go up. So this is the relationship. Then you see if you expecting a recession, right? The recession, then people will shelter their money in the long-term bonds. So the demand for the long-term bonds will increase. Then if the demand is increased, so will increase the bonds price. The bonds price increase will decrease the bonds yield. So you have to understand those relationships then to understand the shape of the curve. First, when we talk about the normal curve, the reason we say normal is risk reward holds. We basically, if you invest the short term, let's say 1 year bonds, you should expecting lower yield than you invest in the 30-year bonds, right? So this is upsloping, so it's normal. we say this when this happened, this normal curve is in the economic expansion. Why you say that? So basically, here we just say investors who risk their money for a long-term period expect to get a bigger reward in forms of the higher interest rate than those who risk their money for the short-term period. So this holds is only the economy is good. So the investor can invest in elsewhere. They can invest in the stock market or invest in the economy, open a business. They can get a higher return with less risk in those situations, so they are less demand for the long-term bonds. So if they want to buy the bonds, they require the bonds to pay higher yield to them. So that's in good economy, they're demanding higher yield in the bonds because you don't need to shorten your risk because the market is good. Then the expectation of the increase interest rate or inflation. So if you expect that the future interest rate or the inflation going to increase, you don't want to hold a long-term bonds. So you will require higher yield from the bonds if you want to buy one. So that's why this usually happens. Most of the time it's normal. The yield curve are normal. They are in the economy expansion. So steep yield curve. This is in the year of 1992. So it's usually is economy expansion. So steep the yield curve. The curve you can see here, the slope is very sharp, steep. So typically they said that typically the yield on the 30-year Treasury bonds is 3% above the yield 3 months of the Treasury bills. When it gets wider than that, the slope of the yield curve increases sharply. So here is 4.27, so it's greater than 3%. So we can consider this a steep yield curve. So risk reward, yes. So basically say, I'm holding a short period, so we had a lower rate, then the investor demand higher and higher the yield when they hold longer. This one usually say this shape typically at the beginning of the economic expansion just after the end of the recession. Well, so they if the investor can invest their money, so they can invest their money in the economy, opening a business, or invest in the stock market, they can get a higher return with less risk. So nobody want to invest in the bonds, so they will require the bonds to pay higher yield. So that's why the yield increase. So also, if you expecting the near term the interest rate and the inflation increase, so nobody want to hold the bonds. So they expecting the bonds, the yield are gonna increase. So that's steep yield curve is in the economic expansion. Now we talk about the flat yield curve. This is in May 2019. May 2019, the yield curve is almost flat. So so basically you can look at all the yield for 1 month to 30 years. They are almost indifferent. Can you imagine you holding 1 month the bonds? They you don't have the difference. You don't get the you hold 30 years, won't get difference higher return. So basically say risk reward is not holding here, right? Investors are not being paid for the additional risk that they are taking by the extending maturity. So occurs when the economy is peaking. Basically tell you in the May 2019, so economy is peaking. Then the economic slowdown is on the way. So investing in the elsewhere cannot get the higher return with less risk. So basically say when you invest in the business, in the economy, you start business, you invest in the stock market, you invest in the real estate, investing all kinds of business, you just don't get the return because everything becomes so expensive, then you just don't get a return. So you will, you just put it in the long-term bonds, then you even get better return. So that's why they investor willing to accept the lower return. So this is also expecting the decrease interest rate or inflation. If you think the interest rate gonna go down further, so you are happy to hold the long-term bonds at a higher rate. So this is before 2020 recession. So now we can get the humped yield curve. So this is in the October 1997. So economic slowdown, right? So you can see the reason is humped is we said is the upward sloping line that initially rises then beginning to fall at a longer maturity. So you can just see this 5-year, 7-year, 10-year, 5-year. You can see here is increase. 5-year yield to 7 is increase. Then 7-year, the 10-year, the yield is lower than 7-year. So this kind of have a little hump here. So this is very similar to the flat yield curve. So basically risk reward. So you hold a 10-year, you're not getting the higher return. So risk reward, no here. So you indicated the economic slowdown. You basically you invest your money elsewhere cannot get the higher return with less risk. So expectation of decrease interest rate. So if interest rate are gonna decrease, so it's good to hold the bonds, right? So this is 1997 is before the 2000 tech bubble. So now we talk about the invert yield curve. Is this in September 2019? The yield curve inverted. So this was on the news a lot. So when you basically the situation say I hold a 7-year, 10-year bonds, I get a lower interest rate than they're holding a month or holding a year. So that's just you don't get any risk reward. So long-term investors set off a lower yield than the short-term investors. So this indicates economic slowdown. Investing in elsewhere, you cannot get a higher return with less risk. So basically, everybody think a recession is coming. So they don't want to risk any money in the stock market in anywhere else. So they just buy long-term bonds, buying. They also expect the decrease in the interest rate or the inflation. So buy long-term bonds, last chance to lock a long higher yield before the recession. So that's before 2020 recession. So that's why what happened in the economy. Okay, now we talk about today, right? We are in the 2020 first. So the yield curve is become normal again. So basically, we out of the recession. We can say is economic expansion starting because when you out, we are currently slowly out of the pandemic. So investor gonna sell. They think less risk in the market. They want to economy is open. They want to invest their money in the business, in the restaurants, in the supply chain, in the airlines, in the travel business, everything. So they pour money. So basically, they pour money into the so they pour money out the bonds. So they invest in the economy. Then the expansion expectation of the increased interest rate and inflation. So currently, you given the government print all this money for the stimulus checks. So you will, inflation. Everybody talks about the inflation. So when you have an inflation, you don't want to hold any long-term bonds because you locked on the long-term bonds. The future interest rate go up, your bonds gonna decrease price. So that's why.